All right, let's talk about support and resistance. It's one of the first things every trader learns, but here's the thing, it's also one of the most misunderstood and misused concepts out there. Today, we're going to fix that. Let's dive in and finally turn that chart chaos into some real trading clarity. So, does this look familiar? I mean, a chart that's so packed with lines, it looks less like a financial instrument and more like, I don't know, a Jackson Pollock painting. We've all been there, right? Staring at a screen just like this, completely overwhelming. And get this, a staggering 99% of traders are drawing these absolutely crucial levels completely wrong. And this isn't just about making your charts look messy. No, this leads to confusion, to what they call analysis paralysis, and ultimately it leads to bad trades. But what if you could just cut through all that noise? What if there was a simple, repeatable way to find the only levels that actually matter? Well, that's exactly what we're going to break down in this explainer. Okay, so here's the big problem, the core issue. The whole point of marking key levels is to make your job easier, to simplify your analysis. But by drawing dozens and dozens of lines that don't matter, most traders do the exact opposite. They just create a tangled mess that makes it impossible to make a clear decision. So let's just scrap that entire approach. Forget everything you thought you knew, and let's start fresh from the ground up. Because to find the levels that actually matter, you first have to understand what they are, and more importantly, why they even show up in the first place. Okay, the super simple way to think about it is this: support is like a floor holding the price up, resistance is a ceiling keeping the price down. Price hits the floor, it tends to bounce up. Price hits the ceiling, it tends to get pushed back down. Sounds simple enough, right? But believe me, there's a much deeper, more interesting story going on here. See, these levels aren't just, random lines on a chart. They're not magic. They are zones of pure human psychology. They are born from the pain and regret of traders who are trapped in losing positions. Okay, so let me break down how this psychology actually works. At a resistance level, that ceiling, you have a bunch of buyers who thought the price was going to the moon. They bought right at the top and now they're sitting on a loss. All they want is for the price to come back up so they can sell and get out at break even. That collective get me out selling is what creates the resistance. And it's the exact opposite at a support floor. You have sellers who shorted at the low and now they're trapped. When price comes back down, they rush to buy back their shares to get out, and all that buying creates the support. So now that we get the why behind these levels, the psychology of trapped traders, let's get into the how. I'm going to give you a simple four rule system you can use over and over again to find only the levels that truly matter, the ones that can give you a real edge. We're going to walk through each one, finding multiple rejections, identifying those significant moves away from a level, mastering the incredible flip principle, and finally, learning to focus on the nail. Let's do it. All right, rule number one. You want to look for areas where the price has been smacked down or propped up multiple times. If price hits a level and reverses, then comes back and does it again, and maybe even a third time, that's the market screaming at you that this level is important. But here's a little secret: the more a level gets tested, the weaker it can actually become. Think of it like tapping on a wall. Eventually, it's going to break. Rule number two: look for a significant move away from the level. Think about it. If price just taps a level and then rockets away from it or plummets down with huge momentum, what does that tell you? It tells you there was a massive imbalance between buyers and sellers right there. That's a huge clue that it's a very, very important area to watch in the future. Okay, rule number three. This one is a game changer. It's called the flip principle. When price finally musters the strength to break through a really strong ceiling, that resistance, that level doesn't just vanish. It often transforms. It flips and becomes the new floor. That old ceiling just became the new support. And you guessed it, this works in the exact opposite way too. When a strong support floor finally cracks and the price falls through, it flips to become the new ceiling. Honestly, this flip dynamic, where old support becomes new resistance, is one of the most powerful and reliable patterns you'll ever see in the market. And finally, rule number four. And please, please listen to this one, because it's all about keeping your charts clean and usable. You have to focus only on the levels that are recent and actually relevant to where the price is trading right now. You need to practice what I call chart hygiene, getting rid of the old junk. I look how one trader put it. He said, you don't need to care about a level from a year ago if the price is nowhere near it. He called it ancient history. It's dinosaurs. And he's right. If it's not in the current neighborhood of the price, Get it off your chart. Focus on what matters now. All right, so we found our clean, meaningful levels. Awesome. But now, how do we actually trade off of them? Because the single biggest mistake you can make is just jumping into a trade the second the price touches your line. No, no, no. We need more proof. We need confirmation. So here's a simple three-part framework to keep you safe. First, we wait patiently for price to actually reach one of our key zones. That's checkmark number one. Second, we wait for a clear reversal candlestick pattern to form, something like a big bullish engulfing candle at support. That's checkmark two. And third, you could wait for another piece of evidence, like a moving average crossover, telling you the short-term trend is shifting in your favor. That's our final confirmation. So once you get all three of those confirmations, and only then, here's how you can manage the trade. You enter, you place your stop loss on the other side of the level. You don't put it right on the line. You give it some breathing room in case the price wants to test that area again. And for your take profit, you just aim for the next major support or resistance level. This gives you a logical plan from start to finish. Getting good at this isn't just about memorizing rules on a slide. It's about a fundamental shift in your mindset. It's about going from that feeling of chaos and confusion to a state of what I like to call chart zen, just clarity. So let's do a quick recap. What are the absolute key takeaways here? Number one, think in zones, not single exact lines. Price is messy, give it some space. Number two, practice good chart hygiene. Less is more. Clean up your charts. Number three, start on the higher time frames, like the weekly or the monthly. That's where you'll find the most powerful, respected levels. And finally, be patient. Always, always wait for multiple confirmations before you risk your money. When you start doing this, your whole perspective on your chart is going to transform. It stops being this confusing, random mess of lines, and it becomes a story of supply and demand, of fear and greed, of trapped traders, a story that you can finally read. So here's what I want you to do. Pull up a chart, any chart, get rid of all that clutter, apply these four rules, and find the two or three levels that truly matter. And now, take a look. What story is your chart telling you?